bells and whistles, but we'll get to that. Market expectations have gone from 100 plus basis points of rate hikes in the next few years to just 25, which means rates are going up small numbers, not big numbers. The yield on 5-year government bond guides the 5-year rate, and it is below average. So I expect rates to stay where they are or go down very little, not a whole lot.
Go down.
I'm expecting them to go down, but the market, the banks are keeping the profit high right now. What I mean, okay, so let me explain. Bond rates are low, mortgage rates are same, which means the profitability for the bank is still there. Now, they will ride the profit for as long as possible until one of them looks at the numbers, and as soon as the home sales start to go up, they'll drop. And HSBC is one of the first ones usually.
They see home sales drop.
No, they see home sales start to come up, they'll drop the rate just to get the one. If the bond yields drop below 1.74, the result would mean lower fixed rates and lower qualifying rate. I don't expect lower qualifying rate. I don't fully agree with that statement because they are thinking of extending the amortization. When market policies, lending policies are looked at, it's one thing at a time, never multiple things. But when they're tightening, they go from every angle. The slowing economy is making headlines with non-employment indicators weakening by the quarter. So employment numbers last quarter did not come in as good as they were the quarter before. Dr. Sherry Cooper gave some numbers on it. But that's also normal around that time. So we'll see as to what the next ones come to see if it's a trend or it was just a temporary seasonal dip. By the way, I have that link. I will send you on the email, and you can click on full studies of it. 30 years amortization. This is one way to loosen the lending guidelines. So insured mortgages may go up to 30 years. At the moment, conventional is not even talked about. So, and the entire change that I see from 2017 is to push buyers towards going for less than 20% down. Because 20% down, people used to buy, refinance in a year, and so on and so forth. To avoid that, and of course, CMHC is a crown corporation, and government does want to make some money on it, so they want the insured mortgages to be pushed further than conventional. Therefore, they're pushing for 30 years amortization. It was talked in by the Democratic Party in February, and it is very much looked at it carefully. So we'll see next month or so what changes come through. A simple interest rate from current 25 to 30 years helps in many different ways. Three main is it will help renters become homeowners. It gives them flexibility to get same size of mortgage but lower payments, or a bigger size of mortgage, of course. It especially targets assistance for first-time buyers, allowing them for better financial growth. So investors will have smaller payment, buyers will have smaller payment, accommodating their existing debt, and so on and so forth. So but when you look at 25 years to 30 years on a 300,000 mortgage, there's not a whole lot of dollar amount added to that mortgage, but it does push you into the next 25,000 zone. What I mean by that is someone who was able to qualify for a 400,000 condo at 500 monthly fee is now going to be able to qualify at 10% 425. So you're going in the next real estate following me? Yes, no?
Yeah.
Okay, so you know when you do searches for clients, up to 400, this will be up to 425. Okay, it's the 25,000 that it adds, but that's it. It's not a whole lot that it does.
But it's the
Um,
monthly that changes, right? Like the monthly payments that changes with 30-year amortization.
Yes, but see, monthly payment changes, but that monthly payment really does not help us. The monthly payment is lower, but that monthly payment that is lower, everyone's payment lower would be a different number. How it helps you is instead of going for 400, now you can go for 425. Does that make sense?
Yeah.
Because everyone's payment would be lower by a different number, right, based on their income. So essentially at 400, you're adding 25 more if that 30 years goes through. At the moment, it's a very spiral talk, so we'll see where that goes. But tightening the policies, Fisco doesn't ask. It's just, here you go, this is the new policy, but when it's opening up, it takes a while for it to go. Okay. So those are few things that are important and sort of some changes helping us in going forward. So looking at all this, we're implementing a newer plan for us. Few things. There's an app you can download, gives you the entire numbers on your phone to calculate. Helps clients, helps you, what the monthly payment would be, rates are there, and they're live rates, so you can do the calculation and such. But there is a goal that we've developed for 2019. So